Hi, welcome back. It's me again, Russell Slack, the founder of Guided Seasons. Do you remember people coming out of grocery stores with shopping carts overflowing with toilet paper? It was March of 2020, and almost overnight, people changed their buying behavior out of fear. It wasn't because supply chains has collapsed. It was because there was a sudden increase in demand caused by herd mentality. Someone saw other people buying in bulk. They became concerned that there wouldn't be enough left, so they also bought in bulk. That made the shelves look emptier. And the more people saw empty shelves, the more they changed their behavior. And before long, that behavior itself became the problem, and it spread to other everyday items. Now, today, with the concerns over this conflict in Iran and global oil prices, I want to talk about what happens to investment markets during times of war. What is the actual lived experience of investors during these periods? Because when headlines pick up, when oil prices move, when your market account drops, it's very easy to feel like something major is breaking. But history and data tell a different story. When conflicts like this break out, all the talking heads on the news spread fear for clicks. Most of these news programs align more with entertainment shows as they fight for viewership. So uncertainty spreads, and it spreads quickly, and the market prices adjust as fear leads to liquidations. And in the moment, it can feel like things are unraveling. But when you take a step back and you look at the data, the pattern is actually very consistent. Across decades of geopolitical events, the average market decline has been around 5%. This is according to a 2020 report from LPL and CFRA. Markets typically find a bottom within a few weeks and then recover not long after. This is not a prolonged collapse. It's a short-term adjustment. And here's something most people don't realize. Even in good years, years where the market ends in a very positive manner, there is always a meaningful decline somewhere along the way. According to JP Morgan, the average intra-year decline is about 14%. So the question becomes, is this Iran conflict a short-term panic or a long-term adjustment? Because global conflict isn't rare, and the negative market intra-year periods exist in nearly every year. So if you zoom out even further, this becomes even more clear. The CFA Institute published a report that analyzed returns through all the big wars. The market has moved through world wars, regional conflicts, terrorist events, political instability, and yet over time it has continued to grow. The average return through the major conflicts was 11.4% for large cap stocks. Why? Because people are still buying toilet paper, toothpaste, food, and clothing. Businesses continue to operate, economies adjust, capital flows to where it's most productive. The uncertainty doesn't stop long term growth, it just interrupts it for a period of time. And this is where most people unintentionally hurt themselves. It's not the event itself, it's how they respond to it. When markets drop, there is a natural instinct to act, to do something. Sitting still feels uncomfortable. Moving to cash feels like taking control, but this is where that fear and calamity hurts you. When you sell after decline, you haven't avoided the loss. You've locked it in. You've lost years of savings. And at the same time, you've removed yourself from the recovery. Here's a chart from JP Morgan that really drives this home. If you invest $10,000 and stay fully invested over time through these calamities, that amount grows to just over $80,000. But if you miss just 10 of the best days in the market, that results get cut nearly in half. 10 days. And here's what you need to know. Those best days don't happen when things are calm. They tend to happen right around the worst days, sometimes immediately after. So when someone steps out of the market during a shocking day or a week, they're not protecting themselves from a downside. They're locking in losses and very likely missing the biggest growth days. And that's where long-term damage happens. So what are the actions that an investor should take? Because volatility isn't just something to endure, it's something you can actually use. When markets decline, prices are lower. It means you're buying shares, more shares, at the same dollar. And that translates into future expected higher returns. For those regularly contributing to portfolios, downturns actually improve those long term results. It's called dollar cost averaging. Those new dollars are buying at better prices, often just before those strong recovery days, and again, increasing future returns. And for those who have cash in the bank, this is where Warren Buffett's quote applies well. Be fearful when others are greedy, and greedy when others are fearful. When the market catches a cold, if you have the ability, lean in. I know emotionally that sounds backwards, but it's exactly why it works. Now, for those who are retired, this conversation changes a little bit. You're no longer contributing, you're withdrawing. And that introduces a different kind of risk. That's what is called sequence of return risk. And it's one of the biggest risks retirees face. If losses happen early in retirement, while you're taking withdrawals, it can have a lasting impact on your portfolio. This is where portfolio structure becomes critical to building income stability in retirement. A retirement portfolio shouldn't just be about growth. It needs to be built to weather these downturns. This is where adjusting the risk and diversifying into fixed income plays an important role. Not because it outperforms stocks, but because it behaves differently. I often describe it like a ballast on a ship. It doesn't make the ship go faster, but it keeps it steady when the water gets rough. When the markets decline, a balanced portfolio allows you to draw more from those stable assets instead of selling equities at a loss. And that creates something of incredible value: time. Time for your portfolio to recover. And there's another opportunity inside of this. If your fixed income held up better during this downturn, you can rebalance, moving some of those stable assets into growth stocks at lower prices. That allows you to also take advantage of this recovery as it happens. So, when we look at times like this, when markets are reacting to geopolitical events, it's easy to feel like this time it's different. Something's happening. It's easy to let fear pull you away from your plan. But history suggests otherwise. These are short term events. They create temporary volatility and they create noise. And they often create those opportunities for higher growth. What actually changes outcomes? That's your behavior. The toilet paper shortage of the 2020s wasn't caused by real change in production. It was caused by people overreacting to what they thought might happen next. Markets work the same way. Short-term movements are driven by perception and fear. But long-term success comes from discipline, structure, and staying the course. At Guided Seasons, that's what we focus on. Not predicting the next event, but building a plan that can endure what comes next and creating the stability retirees can see. Because over time, it's not the events that determine success, it's how you respond to them. Well, I hope this helped you take a step back and evaluate how you're reacting to current events and how to bring stability back into your financial plan. Until next time, be well.